The other thing that I think I wish I had known at a much younger age when I first took out income protection insurance in particular, and this is why I think I'd love for you to explain, and that is there's sort of two ways that it can be paid or calculated, whatever. Two different types, right? One gets more expensive as you get older, and one is a bit more expensive when you're younger. Now, if I'd known there were two options back then, I know I would have taken the other option. Now, can you explain? And I think you know why I say that.
Yeah, I think, and it's interesting because it's probably, I'd say it with an asterisk as well. So there's what's known as stepped premiums, which are the most common that you'll find in the market. And if you think about it in the way that a stepped premium will start out cheaper as you're young, and every year you have a birthday, not only does the premium rate go up for your age, but it also has an indexation increase as well. The difference between the two, with the level premium, it still has that indexation, but it doesn't have that age-based increase every single year. So it starts out a bit higher, and the break-even point from a pure cost perspective is about 7 years. And then to make sure that you've spent the same in both scenarios, it takes you about 13 years. And if you're going to have that policy in place any longer than 13 years, typically you would love me. Now, there's some pros and cons to it. And one of the big cons is that it relies on the insurance companies doing the right thing as well. Now, and what I mean by that is it relies on them putting their premiums up at standard intervals.
Right.
So standard intervals for the insurance companies is probably once every 3 to 5 years, putting their entire premium book up. Now, you might see it with your health insurance. They're small increases, 3 or 4% each year.
But they're regulated too. They're legislated, those health fund ones.
They are. Now, the other thing with what we've seen, particularly in the income protection, which was one of those ones that would have been beneficial to do, typically when we have a long period of time, some of the percentage increases last year alone were over 130% in premiums at the base level.
So that's not the stepped. That's
no.
Oh,
that's
wow.
both.
So maybe oh, wow, God.
So we're actually unraveling a lot of the things that we've done previously to not be locked in these higher contracts that are with level premium, because we know what's going to happen. And there's been so much change, particularly to income protection, and they've closed off products as of the 1st of October last year. And anyone in these old products are really in a situation where it's a ticking time bomb, and it's going to happen that these books are going to be priced to the point where they want you to move, and they're going to force you out of the old products into the ones that are more favourable for the insurance company. So it's trying to have I spend my days looking at ways to work out how can we offset what the insurance companies are trying to do and give you the power. And one of the things was the level premiums, because it worked. Does it still serve its purpose? And I think no, in a lot of these things. But I think it's, again, looking at it and working through together, and also being flexible enough to say, hey, Veronica, I'd spoken about level premiums before, but this has happened, and we're not going to we need to stop doing that now because of this that's happening, and blah, blah, because we just don't know what the future looks like.